Buying a house is something that pretty much everyone does, and if you haven't done it yet, then you probably aspire to do it at some point. For most of us, it makes perfect sense. We have to pay for the roof over our heads anyway. Why throw money away renting when after 30 years we could actually own the home? Well, that logic is easy to understand, and by and large, it's not wrong. There's no wonder then why buying a house is such a big decision, why it takes up so much time, and why people are always so desperate to know what's going to happen to the housing market. Now, unfortunately, no one knows what is going to happen. We all have our own ideas based on whatever data we have access to, and while some people are more likely than others to be right or wrong, that doesn't change the fact that we are all just trying to work out what is most likely going to happen in the future. With the crazy housing market that we've experienced over the last few years, it's no wonder there are a lot of people waiting to buy a house, sure that a crash is right around the corner, and while that may be true, the crash that we are most likely to see probably isn't what you're expecting, because it will likely be something we've never seen before. History doesn't repeat itself, but it does rhyme, and I think it's about to rhyme again, so that's what we're going to cover today. But first, leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts for my own personal portfolio. So where did the housing market boom come from, and why did we see it in almost every country? Well, basically, it's really down to the actions of our governments and how every government, or almost all of them at least, in the West tried really hard to ensure that economic activity didn't slow down and that we didn't fall into a recession when lockdowns hit. Now, despite what some people say, in and of itself, this isn't actually a bad thing. The economic hit that we saw over 2020 and even 2021 in some places wasn't from the virus itself, but from our reactions to the virus and in particular to the lockdowns. Our governments forced our businesses to close. They forced us to stay in our homes and not to work our jobs. It would have been pretty ridiculous if they hadn't at least tried to stop us all from going bankrupt. So they sent out checks, they blocked evictions and foreclosures, and they tried to stimulate the economy. What wasn't really expected by most people, but what seems blindingly obvious in hindsight, was that housing prices were going to explode. In some countries, there was fear of an instant housing market crash, especially in the UK where I live. Everyone started to panic that we would all lose our jobs, stop paying our mortgages, and prices would crater. So the government sought to increase confidence by reducing stamp duty, a tax that we pay when we buy property. It turns out that this direct support wasn't actually needed and prices went up an awful lot as a result. And while it may not be identical everywhere, it's a really similar story all over the world. There was too much support from governments, people often found themselves with more cash than before, and a buying frenzy for homes begun. Again, it seems so obvious in hindsight that when people are forced to spend all their time at home, of course they would choose to move to a bigger home, with more room, a bigger garden, or a nicer location, but not many people actually saw this coming in advance. In particular, people left cities that were becoming a little infamous for being very expensive and having poor qualities of life. Places like LA, New York, and London saw mass exoduses. The housing markets in many of these cities actually performed worse than you probably realize. Prices didn't go up by all that much, especially when compared with other areas, and rents often actually fell quite a bit. But in cheaper states, places a little bit further away from these economic powerhouses, the markets boomed like we've never seen before. I know you've heard about the meteoric rise of Austin, Texas and other cities like it, driven largely by those people who left California and New York now that they were able to. But the truth is, homes have gone up a crazy amount in places that don't really make sense. Small towns that really aren't that desirable and haven't seen any mass immigration have also seen sky-high prices. It's just been fueled by the people that are already living there and big businesses. Now, it might not be breaking news right now, but a few months ago it was. Banks all over the world were starting to buy up Western homes at a pretty alarming rate. They used their huge cash reserves, often literally billions worth, to buy homes in bulk before they even reached the market, and in doing so, they throttled supply. Earlier this year, it emerged that BlackRock, one of the largest companies in the world, bought an entire subdivision of homes in Conroe, Texas. A bidding war broke out between institutions for a development of 124 homes that were brand new. In the end, they paid $32 million for the entire group, roughly twice what the homes would have sold for on the open market, and the builders didn't even have to shell out for the usual fees like realtors. The simple fact is, when something like that happens, ordinary people cannot compete at all. There is just no way for them to put forward an offer even nearly as compelling as one by a billion-dollar institution. And in this market, a new competitor emerged, one that was trying to become a market maker. We're obviously talking about iBuyers, and if you've heard anything about Zillow recently, you probably know what's coming. Now, for those of you who don't know, a market maker is someone who basically enables a market to function. Usually we refer to brokers as market makers, people or organizations that help buyers and sellers to find each other so that they can transact with the assistance of the broker. Zillow and numerous other iBuyers or instant buyers do exactly what the name would suggest. They buy homes instantly based on some basic information you provide them with. They look at the size and location of a home, the condition of the interior, and the market in which that home exists, and they offer to buy the home far faster and with far less hassle than would usually be possible. But these iBuyers don't actually want to own the homes themselves. They want to pass them on to another buyer who can't transact as quickly. Now, this business model isn't new, and it has existed for decades or even centuries in various different markets. Those We Buy Any Car websites are probably the best known example, but these practices are now common in the housing market, which basically meant there were far more buyers than usual, which forces prices up as competition was high. This was made even worse by the fact that these institutions usually bought with cash, and they were able to just waive usual practices that individuals couldn't risk doing. So demand for homes was soaring, both from ordinary people seizing an opportunity to move into a different home and increase their quality of life, but also from institutions who were seeking to make a profit. At the same time, supply was being squeezed as the pandemic impacted every country in the world. We all saw the news on the dramatic increase in lumber prices earlier in the year that led to houses becoming more expensive to build. Now, the idea that wood becoming more expensive would make building houses that are largely made out of wood also more expensive is quite easy to wrap your head around, but the truth is that the supply of homes was constrained by far more than just raising lumber prices. The labour shortage that is now widely reported on has been building for months now, and it's especially strong in areas of manual labour like home builders. Lots of people just don't want to work for a myriad of different reasons, but this means that projects take longer to complete. Wages for the staff to build these projects are higher, and so fewer homes are built, and those that are built often demand a premium. Then there are the hundreds of other supply-side shocks like rising oil prices. Now, it might not be blindingly obvious, but when oil prices rise and gas prices with them, everything gets more expensive because everything has to be transported from one place to another, and the vast majority of commodities or goods get transported around a fair bit more than just that. That means that building homes got more expensive as well due to the costs of transporting materials increasing, but also as those materials increased in costs as well. In short, prices rose because demand shot up at the exact same time as supply collapsed, and anyone with even a basic understanding of economics will be able to tell you that. Now, if you're like me, you care about personal finance and you try to be smart with your money, then you need to hear about this video's sponsor, BLOCKFI. Now, BLOCKFI offers a crypto earn platform that allows you to earn interest on whatever crypto you hold, including stablecoins. Personally, I like to keep around $10,000 in cash that I can access quickly at any point just in case. Now, I don't want to put that money in stocks in case I need it during a market downturn. So what I do instead is I hold $10,000 worth of stablecoins on a BLOCKFI earn account, earning me 9% interest a year. I can still access the money anytime I like. I don't have to worry about market fluctuations, but I also don't have to put up with a measly 0.5% interest a year that I'd get with a savings account. For anyone interested in BLOCKFI, there's a link down below in the description. If you have an emergency fund that isn't making you money, then I highly suggest you check them out. You can also get up to $250 in free Bitcoin when you sign up using the link down below in the description. Now, since the housing boom though, since the work from home hype has started to die down and the new normal has come and mostly gone, the housing market has started to cool down all over the world. Prices have risen a ridiculous amount and most people just can't afford to transact at these new inflated prices, so the demand for homes has been waning. Banks have also been showing signs that they're actually worrying about a potential crash, and that has only been making it harder for people to buy homes. You've probably heard of it happening, but many lenders or mortgage providers just don't trust market rates right now, so they're refusing to give mortgages based on a home's full value. They don't care that the sale price is what the true value of the home is today because they're worried that in the future the sale price will drop dramatically and they'll end up unable to recoup their loans. Most emigration from larger cities to smaller ones has already happened, which means that the spike of demand that we saw in the wake of the lockdowns has started to ease as well. Consumer sentiment has dropped off a cliff recently, and it hasn't been this low since the worst period of the 2008 recession. Now, what that really means is that people aren't spending as much money as usual because they're worried about the economy, about the stability of their employment, and their ability to pay their bills. All of this and more has come at the same time, and it's already started to influence the housing market. The rate of growth of property prices has been falling across the board, and there are some cities like Boise in the US which have seen demand for homes absolutely collapse in recent months. The booming housing market that came in the wake of the virus that many people said would last for years has already shown signs that it's on its way out, and the cool down has begun. Now, it's probably not news to you, and it's certainly not news to me, but inflation is really high right now. Now, many of us have been saying that this was coming for months, but to be honest, none of that matters anymore. What matters is that it's here, and there's only really one way to fight it. Central banks have to raise interest rates. Inflation is really just an overheating economy, a market where demand is higher than supply, and people bid against each other both in literal auctions and in standard everyday pricing mechanisms and force prices upwards. Purchasing power of our currencies, whether it's dollars, pounds, or yen, decreases, and people start to feel the pain. Raising interest rates slows everything down. People take out less debt because it costs more money. They pay off the debt they already have because it costs more money. Businesses invest less in equipment, technology, and people because it all costs more money. Savings rates go up as banks start to return more to you in interest each year as well, and all of this together slows the economy down. It stops people spending, it reduces demand, and eases inflation. Now, with the inflation we're seeing today, interest rates rising are a matter of when, not if. We know they are coming, and at the moment it seems as though they're still likely at least half a year or so away. But to be honest, I think that's far too optimistic. With inflation the way it is, it's very likely that interest rates are going to be rising at the bare minimum by a few percentage points. But a lot of people don't quite seem to grasp how important this is, and that's usually because most people have 30-year fixed-rate mortgages, so they think they are insulated from interest rate rises, but that just isn't the case. Now, if you have a mortgage that is fixed over 30 years at something very low like 2 or 3%, then on the surface, you'd be right to think that interest rates rising won't hurt you. Your monthly payment will stay the same no matter what, and with inflation as high as it is, your mortgage will probably get inflated away, so having that debt can seem like a positive. The problem with this line of thinking, though, is that it assumes that you are the only real actor, and that the only thing that matters are your monthly payments and nothing else. Should interest rates rise to something like 5%, which would seem very high to us today, but in the grand scheme of things, and according to historical precedent, really isn't that high, then everything would likely change. People looking to buy a home would not be able to get the same 2% mortgage that you have. They'll be stuck with a 6 or even 7% interest rate. Now, while your mortgage of $200,000 at a rate of 2.5% only requires $790 a month, the new entrant to the market, also with a mortgage of $200,000, would have to pay $1,300 a month, almost twice as much. They'd need a far higher income to afford the same house that you have, which means that the number of people who can afford to buy your home will shrink. Demand for your home will drop, and the price of your home will fall with it. The price of your home is dependent on those who are actively moving house, selling or buying. It is not dependent on your circumstances if you're just sitting happy making your monthly repayments, and of course this would happen at every different price point. If the cost of a mortgage rises by 25%, then the base price of the home is going to have to come down to counteract that rise, or else there wouldn't be equilibrium in the markets and no homes would ever get sold. So now you still live in your home that has fallen in value. Hopefully not by too much, but if you only put 3.5% down, then there's a decent chance the debt on your home is actually larger than the value of the house itself. But as long as you keep making those monthly repayments, then you are really fine. As long as you don't need to move house and you can wait out the market within 5, 10, or maybe even 15 years, you'll be back in the green. The huge caveat there is the if. When housing prices fall, a recession often occurs as well. That means people who work as independent contractors or run their own businesses make less profit. That means people who work for huge corporations get made redundant and find themselves without a monthly income. Suddenly, many of those people who used to be able to pay their mortgages no problem have suddenly found that the opposite is true. They don't have a choice anymore, they have to sell their home, which is bad enough already as prices have now fallen, but on top of that, the place they now move into requires a new mortgage with a higher interest rate. There are thousands of other reasons why people have to move, and they don't just stop coming up when a recession hits. Family problems, elderly parents who need caring for, young children that you want to get into better schools, all of these result in problems. On top of all that, the prevalence of variable rate mortgages are actually increasing, which can seem great on the surface. A bank might offer you a measly 1% interest rate for the first 5 years, which seems great at first, but after those 5 years are up, you get forced back into the market rates, which leads to the same problems we just discussed. In Canada, a mortgage has to be renegotiated every 5 years, and in the UK, fixed rate mortgages past the 5-year mark are incredibly rare to come by. The reality is that just because you personally might have a great low fixed rate mortgage, that doesn't mean that everyone else does, and it also doesn't mean that the market won't be affected by raising rates either. Now, in the past, in 2008, the problem with the market was widespread mortgage fraud, lending standards that were being eroded away. People were buying homes with no income, no assets, and no down payments purely because they thought the housing market would always go up, so it wasn't a problem. Today, the problem is different, but the results could well be similar. History doesn't repeat, but it does rhyme. All we can do is be financially responsible. We need to live within our means, ensure that we can easily pay our debts as they are, and that the same is true even if those interest rates rise. Don't take out super unnecessary debt. Don't buy expensive luxury cars we can't afford or buy a Rolex on finance. Fiscal responsibility is the only real way to secure ourselves against what could be coming. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts for my own personal portfolio. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USD Coin, which is a far higher rate than you'll get from any savings account these days. Thank you all for the support, thanks for watching, stay stoic, until next time.